Welcome. In today's discussion, brought to you by the experts at Pro Tax Accountant, we're tackling a huge question with some surprisingly costly answers. I mean, think about it. It's one of the most generous gifts you could ever give, right? A truly life-changing gesture that could give someone total financial freedom. But before you hit send on that massive bank transfer, you really need to pause for just a second.
Okay, so let's get right into it because that amazing act of kindness could have some seriously big tax consequences if you're not careful. We're talking about a potential 40%, yep, 40% tax bill going straight to HMRC.
So, where does this come from? Well, the biggest risk by far, the one that catches almost everyone out, is something called inheritance tax, or IHT. This is the big one, the hidden trap in your generosity that you absolutely have to know about.
You see, when you pay off that mortgage, HMRC doesn't just see a simple gift. Oh no, they see something with a very specific name, a potentially exempt transfer, or a PET for short. And that word potentially is the key. It's only potentially tax-free. It all boils down to a 7-year countdown.
All right, let's talk numbers. For the 2025 to 26 tax year, this is the magic number you have to burn into your brain. £325,000. This is your inheritance tax threshold, also known as the nil rate band. Basically, anything in your estate below this number is totally tax-free. But, and this is a huge but, if your estate, and that includes the massive gift you just made, tips over that £325,000 threshold, well, anything above that line could be taxed at a jaw-dropping 40%. Just think about that. 40% of your gift could vanish, going straight to the taxman instead of your loved one. And this is where that 7-year countdown I mentioned really comes into play. It's all about timing. If you pass away within the first 3 years of giving the gift, boom, the full 40% tax rate applies. But the longer you live after that, the less taxes due. It's a system called tapered relief. And if you make it past the 7-year mark, the gift becomes 100% tax-free. You've cleared the hurdle. Okay, looking at this table really brings the numbers to life, doesn't it? Let's run a quick scenario. Imagine you gift £200,000 to pay off your daughter's mortgage. Now, if you were to pass away in, say, year 4, you can see right there, the tax rate on that gift is still 24%. You know what that means? A potential tax bill of £48,000 for your family to deal with. That is a huge, shocking cost nobody wants. But hang on, don't panic. Stay with me because I'm about to show you how to get around all of this.
So the big question is, how do you make this incredible gift without the massive tax headache? Well, the good news is there are several really smart strategies you can use. Let's walk through them one by one. Okay, first up, a pro tip for you. Everyone, and I mean everyone, has a £3,000 annual gift exemption. This is an amount you can give away every single tax year that is immediately 100% exempt from inheritance tax. And get this, if you didn't use last year's allowance, you can carry it forward. So that's a £6,000 tax-free gift right there. It's a fantastic tool for chipping away a mortgage without any tax worries.
Now, here's a lesser-known rule that can be a real game changer, especially if you have a high income. It's called gifts out of income. Basically, if you can prove you're making regular mortgage payments from your surplus income, money you don't need for your normal standard of living, those gifts can be entirely IHT-free. This is perfect for, let's say, a successful business owner in London with a steady high income. But, and this is crucial, HMRC will want to see solid proof, so your record keeping has to be absolutely perfect. All right, so for a big one-off lump sum, you've really got 2 main paths. The first is a direct gift. It's simple, for sure, but as we've seen, it's a potentially exempt transfer, which means it's risky because of that 7-year rule. The other option? Putting the money into a discretionary trust. Now, this is what's called a chargeable lifetime transfer. I know it sounds complicated, and yeah, it takes more work to set up, but it gives you total control, and here's the key part. It can immediately remove the money from your estate for tax purposes, as long as you stay under that $325,000 threshold. There's a third option, and this one is pretty clever. You can structure the payment as a formal interest-free loan. This completely sidesteps the 7-year gift rule because, well, it isn't a gift. It's a debt that's owed back to your estate. Now, the absolute key here is paperwork. You must have a formal, written loan agreement. If you don't, HMRC will just look at it and say, nope, that's a gift in disguise, and suddenly that whole IHT risk is right back on the table. But that's not all, and here's where a lot of people go wrong. The rules can get even more tangled up in certain situations.
And it's these tricky little scenarios that can trip you up and lead to some really nasty, unexpected tax bills. Yeah, you've got to be extra cautious in some cases. For instance, paying a business partner's mortgage, that could be seen as a taxable benefit in kind for them. What if the property or the person you're helping is outside the UK? You could be looking at the risk of double taxation. Or what if you become a co-owner of the property? That could trigger a whole different tax, capital gains tax down the line. This is where getting it right really, really matters.
So, with all that in mind, how do you pull all this information together and actually create a bulletproof plan that's tailored to you? Let's break down these simple, practical next steps you can take. You can start with this really simple 4-step action plan. Step 1, know the exact number. Calculate the full mortgage amount. Step 2, review all your available exemptions, like that £3,000 annual one or gifts from income. Step 3, decide on the best structure for you. Is it a gift, a trust, or a loan? And step 4, and this is so important, document absolutely everything. This not only clarifies your thinking, but it creates the paper trail that HMRC will demand to see.
And just look at the real-world impact of getting this right. This is a quote from a pro-tax accountant case study. They had a client in Birmingham who wanted to gift £180,000. By setting up a trust, they helped that client completely avoid a potential, get this, $72,000 inheritance tax bill. £72,000. That is a massive saving, all thanks to some smart planning up front.
Look, the bottom line is this. A generous gift deserves smart planning. It's that simple. A gesture this big, this important, deserves the right protection to make sure your hard-earned money helps your loved ones, not the tax man. It's about protecting your gift and your family's future.
So, the question is, are you ready to make a plan that truly protects your gift and your family? You shouldn't let these tax complexities scare you off from making a gift that could change someone's life. The team at ProTax Accountant, well, they specialize in crafting custom strategies for exactly these kinds of situations, making sure your generosity is as tax efficient as it possibly can be. For personalized advice that's tailored to your exact situation, the absolute best thing you can do is reach out to the experts. You can contact ProTax Accountant by phone, on WhatsApp, or by email. They can literally guide you through every single step of this process, from the first thought to the final signature. And hey, for more guides just like this one, where we break down really complex tax topics into simple, actionable advice, make sure you subscribe to the ProTax Accountant YouTube channel. Thanks so much for watching.